Market Recap. I'm Daniel.
And I'm Mira.
So, right off the bat, you're going to notice a slightly different vibe today.
Yeah, definitely not our usual quick daily hit.
No, not at all. This is a weekend special. We are completely clearing the decks today because, honestly, we needed the time to do a proper, long-form deep dive into a single massive event.
Right, the Cerebras Systems IPO.
Exactly. We are doing a forensic analysis of their S1 filing and the underlying due diligence report.
And, before we even pull the thread on this, we really need to establish our mandatory baseline.
Always. Let's hear it.
Everything we are discussing today is strictly for market context, right? It's for intellectual exploration and mechanical analysis.
Yeah, this is absolutely not personal investment advice.
No, definitely not an investment recommendation. We are looking at the physics, the accounting, the structural dynamics of this filing.
Yeah.
We are not managing your portfolio.
Well said. So let's just set the macro stage here for you, the listener. The market environment right now is it's just staggering.
It really is.
Cerebras is targeting a valuation somewhere between like $26.6 billion and $33 billion.
Which is a massive range, by the way.
Right. And the IPO is reportedly 20 times oversubscribed.
20 times. Just let that sink in for a second.
Institutional investors are just absolutely foaming at the mouth for what the press keeps calling the Nvidia antidote.
But when you actually look under the hood, when you read the fine print of this S1 filing, you realize this isn't just a simple story about a faster microchip.
No, it's not. You uncover these mind-bending physics problems, massive geopolitical revenue shuffles.
Oh, the revenue shuffle is wild.
It reads like a spy novel. And then you find this highly complex circular accounting that is basically propping up the whole valuation.
Exactly. So to tackle this, we are going to break today's deep dives down into 4 distinct sessions. We'll hit the financials, the silicon physics, the supply chain, and finally, the cap table mechanics.
Perfect. So let's kick things off. Session 1. Are the explosive financials of the Cerebras IPO actually an illusion?
It's a great question, because the surface narrative being pitched is just, we built a chip that's bigger and faster.
Right, but the math, I'm looking at their 2025 revenue projection. It's $510 million.
Yep.
And I honestly cannot make the math work to get to a $30 billion valuation from that. What am I missing here?
Well, you're not missing anything in the math. What you're seeing is an anomaly in market psychology.
Okay, unpack that for me.
So let's break down the headline numbers. Cerebras is going public on the NASDAQ, ticker symbol CBRS.
Got it.
The initial pricing range they floated was $115 to $125 per share.
Which nets them, like 3-point-something billion in fresh capital?
Right, roughly 3.24 to 3.5 billion. But because institutional demand is just rabid right now, the underwriters, Morgan Stanley, Citi, Barclays, they're looking at pushing that range up to $125 to $135.
And at that top end, if you fully dilute all the outstanding options and warrants, that's how you get to that $33 billion valuation.
Exactly. Now compare that $33 billion to their projected 2025 revenues of $510 million.
That implies an astronomical 45 to 52 times trailing revenue multiple.
It's wild.
Historically, even during the absolute peak of the dot-com bubble or the 2021 SaaS craze, a 50x revenue multiple on a hardware company was basically unheard of.
Because hardware has physical constraints, right?
Right. You have supply chain realities, margin ceilings. It's not software. So why is Wall Street paying software multiples for a company that bends metal and silicon?
Because they aren't actually valuing Cerebras based on its standalone fundamentals. They are valuing it as an industry-subsidized proxy war.
Ah, the Nvidia factor.
Exactly. You have to look at the entire tech ecosystem right now. Nvidia dictates absolutely everything.
They dictate the pricing, the allocation,
the architectural roadmap, the CUDA software ecosystem, everything. Nvidia is effectively the toll booth for the entire AI economy.
Every single dollar flowing into AI eventually pays a tax to Nvidia.
And that tax is becoming an existential threat for everyone else. If you're a VC syndicate or a hyperscaler like Amazon, Google, Microsoft, you share this desperate structural mandate to commoditize AI hardware.
Because if Nvidia keeps pulling in 75% gross margins, the economics of training these trillion parameter models just falls apart.
Right. All the economic value gets captured by one company in Santa Clara, while the hyperscalers are footing multi-billion-dollar utility bills.
So the market literally needs this IPO to work. They are paying this premium as a hedge to fracture Nvidia's pricing power.
That perfectly explains the capital flow.
Yeah.
But it does not excuse the underlying structural fragility of where Cerebras is actually getting its revenue.
Let's get into that, because on the surface, jumping to $510 million in 2025 looks fantastic. It's a 76% jump from 2024.
It looks great until you do a forensic decomposition of that revenue base. In 2025, 86% of the company's total revenue came from exactly 2 entities.
Oh, wow.
And both of those entities are explicitly linked to the United Arab Emirates.
Okay, let's slow down and really look at this UAE revenue shuffle, because this part of the filing is just wild.
It really is. In 2024, Abu Dhabi's G42, which is this massive AI holding company backed by sovereign wealth, they accounted for 85% of Cerebras' total revenue.
Think about that. One single foreign entity was basically funding the entire operation.
And, unsurprisingly, the U.S. government noticed.
Right, because advanced semiconductors aren't just commercial products anymore. They're a critical national security infrastructure.
Exactly. The Commerce Department and CFIUS, the Committee on Foreign Investment in the United States, they initiated intense regulatory scrutiny.
There are huge bipartisan concerns in Washington about tech transfers to the Middle East, right?
Yeah, the fear is that if you ship supercomputers to the UAE, they could serve as a backdoor for tech to reach restricted entities in China, which would be a massive export control violation.
So the U.S. government steps in. What happens to the G42 money?
Well, in July 2024, Cerebras and G42 filed a joint voluntary notice with CFIUS.
Voluntary, sure.
Right, voluntary is often a polite legal fiction. Fast forward to March 2025, under crushing pressure from regulators, that G42 investment was forcibly unwound. Their revenue share plummeted from 85% down to 24%.
But wait, you just said that the total UAE link revenue stayed at 86% in 2025?
Yep.
If G42 dropped to 24%, where did the rest of that revenue come from? How does the math work?
This is the shuffle. Miraculously, a new entity stepped right in to fill the exact void on the income statement.
Who was it?
The Mohammed bin Zayed University of Artificial Intelligence, or MBZUAI. It's an Abu Dhabi-based academic institution.
Oh, come on.
I know. In 2025, this university suddenly accounted for 62% of Cerebras' total revenue. The S1 filing explicitly notes that MBZUAI agreed to assume $350 million of G42's original purchase commitment.
Let me get this straight. The U.S. government applies massive pressure on a sovereign-backed commercial company over national security.
Right.
So they just shuffle the remaining $350 million purchase order over to an academic research institution in the exact same sovereign jurisdiction.
Precisely. It's a geopolitical shell game. It shifts the optics because it's much harder for regulators to crack down on academic research partnerships than commercial data centers.
But structurally, it mitigates absolutely nothing. They are still entirely dependent on this specific Middle Eastern network.
Exactly. So let's strip that out for a second. If we back out the 86% of revenue tied to the UAE, what are we left with?
What's the actual diversified enterprise revenue?
Approximately $71.4 million.
71 million. They are pricing a company at nearly $30 billion based on 71 million in diversified commercial traction. That is staggering.
It's hard to justify.
But let me challenge you on this, Mira, because I can hear the institutional counter-argument already. Are we being too cynical here?
How do you mean?
Well, in the hyperscaler world, building custom data centers takes billions in upfront capital. Isn't landing a massive sovereign wealth buyer just the cost of doing business and reaching scale?
Sure, if it was standard commercial risk.
Right, like maybe this extreme concentration risk is already priced in by the institutions oversubscribing the IPO. They know Abu Dhabi pays the bills. They just want a competitor to Nvidia, and they accept the risk.
That is a completely rational argument if 86% of their revenue came from, like Netflix or Uber. If Netflix cancels a contract, you take a hit and pivot. But we are talking about sovereign risk layered with CFIUS oversight and export controls.
Totally different animal.
Completely different. If one single executive order from the Commerce Department alters export regulations for the Middle East, 86% of Cerebras' revenue vanishes, literally overnight.
You can't just pivot away from a federal export ban.
Exactly. You're left with hundreds of millions in stranded assets. You simply cannot price in an existential regulatory guillotine.
That is a terrifying precipice to walk. You're essentially betting a $30 billion valuation on the continuous goodwill of Washington regulators.
And it gets even crazier when you look at how they are reporting their profitability.
Right, because if you scan the headlines, Cerebras reported a net income of $237.8 million for 2025.
On paper, it looks like a massive triumphant swing from a nearly $500 million net loss the year prior.
It looks like they've achieved incredible operating leverage.
Yes, but you have to dissect the consolidated statements of cash flows. When you do, you realize that this $237 million profit is a pure accounting illusion.
Explain that, because to a layman, profit means you sold a product for more than it cost to make, and you have cash in the bank. Where does a profit come from if it's an illusion?
It comes from a massive $363.3 million non-cash gain, specifically the change in fair value of forward contract liability related to the G42 investment.
Okay, break down the gap accounting on that for me.
Imagine you sign a contract requiring you to issue a bunch of stock in the future at a specific price. Accounting rules require you to record that future obligation as a liability today.
Makes sense.
As the company's value changes, the theoretical cost of that obligation changes. In 2024, when Cerebras was growing, the cost of handing over those shares went up, so they recorded a massive $400 million paper loss.
Okay, so they recorded a paper loss. How does that turn into a profit in 2025?
Because of the U.S. government. When CFI US forced the unwinding of the G42 agreements, that future obligation was legally voided. And under accounting rules, when a massive liability vanishes from your balance sheet, you record it as a gain. So they get to write down a $363 million paper profit.
Wow. It has absolutely nothing to do with selling actual wafer-scale engines or generating real cash flow. It is just a mathematical artifact of a canceled contract.
Exactly. So if you back out this canceled contract gain and you back out stock-based compensation, which doesn't use cash, what does the core business actually look like?
Are they making any actual money?
Not at all. True operating cash flow for 2025 was negative $10.05 million.
That's a huge operational deterioration from 2024, right?
Well, 2024 had a positive operating cash flow of $451 million, but even that was highly misleading. It was driven entirely by massive customer prepayments from G42.
Strip away the sovereign prepayments and the accounting illusions, and they are bleeding liquidity.
Badly. R&D expenses jumped 54% year over year. Sales and marketing surged 237%. And arguably the most troubling metric for a hardware company, gross margins actually compressed, falling from 42.3% down to 39%.
Margin compression is the exact opposite of what you want as a hardware company scales. You want your unit economics to improve.
Right. But standing up proprietary cloud infrastructure is incredibly capital intensive.
So their revenue is tied to a geopolitical shuffle, and their headline profitability is a mirage. If the financials are an illusion, what exactly are they trying to sell to justify this valuation?
Well, to understand that, we have to look at the physical impossibility of what they just built.
Which brings us perfectly to our next section. So let's take a quick break here, wrap up this thought. The top line numbers are wildly illusory.
Definitely.
When we come back, we are going to look at the actual hardware, because the engineering here is insane. Welcome back. Let's get right into the hardware. Session 2. Does the physics of a giant AI chip actually work at commercial scale?
This is where the story shifts from financial skepticism to just genuine, awe-inspiring engineering.
It really is. To understand why Cerebras built a microchip the size of a dinner plate, you have to understand the fundamental physics that govern every other chip on the planet.
Exactly. Let's talk about traditional semiconductor manufacturing, specifically the reticle limit.
Right. So when TSMC or Intel makes a chip, they start with a massive circular disk of pure silicon, right? A 300 millimeter wafer. But they don't turn the whole disk into one chip?
No, because standard photolithography limits the size. They use these incredible multi-million-dollar stepper tools. They use extreme ultraviolet light to print microscopic circuits onto the silicon.
Like a projector.
Basically, yes. But the lens and mirrors can only project a focused image over a very specific, limited area in a single pass. That max area is the reticle limit, roughly 800 square millimeters.
Okay, so when Nvidia designs their flagship H100 or the new Blackwell B200, they are physically constrained by that 800 square millimeter boundary.
Right. They slice the wafer into hundreds of these little squares, throw away the defective ones, and package the functional ones.
But 800 square millimeters is nowhere near enough compute power or memory to run a massive AI model like GPT-4 or Llama 3. So how does the industry solve this?
They use modularity. They take a bunch of these smaller chips, stitch them together, and use highly complex external wiring like Nvidia's NVLink to get them to share data.
And this modular approach introduces the great physical bottleneck of our era, the memory wall.
The von Neumann bottleneck. The processing cores are incredibly fast, doing trillions of math operations per second, but they don't have enough room inside that 800 square millimeter die to store all the data.
They have to reach outside the chip to fetch data from external memory banks.
Right.
It's like having the world's fastest Michelin star chef in a kitchen, but the pantry is 3 miles down the road.
That's a great analogy.
It doesn't matter how fast the chef can chop vegetables if he has to drive 3 miles to get a single onion, drive back, chop it, and then drive 3 miles to get a carrot. The kitchen speed is totally limited by transit time.
And that is exactly what happens inside a GPU. Every time the processor has to move data off the die across a copper wire to fetch data from memory, it incurs a massive latency penalty.
The processor literally sits idle, waiting for the data.
In large language models, this is catastrophic during the decode phase. When ChatGPT generates a response, it does it one word or token at a time, sequentially.
It has to load the entire neural network into its memory, calculate the first word, then load it all again for the second word.
Yes, the logic is fast enough. The data movement is the wall.
Enter the Cerebras Wafer-Scale Engine 3, or WSE3. Cerebras looked at the reticle limit and the memory wall and just decided to bulldoze the entire paradigm.
They completely ignored the rules.
Instead of taking that 300 millimeter wafer and slicing it up, they simply don't cut it. They take a single contiguous square measuring 46,225 square millimeters and operate it as one single massive chip.
The specs are almost incomprehensible. 4 trillion transistors, 900,000 AI-optimized cores. But the true magic is the memory.
Right, because it's so massive, they don't use external memory banks. They put 44 gigabytes of SRAM memory directly on the silicon.
And let's clarify why SRAM is so important. Standard GPUs use high bandwidth memory, which is dense but relatively slow. SRAM is insanely fast, but physically massive.
Nvidia can't fit 44 gigs of SRAM on an 800 square millimeter chip. There's no room. Cerebras has the room. They put the pantry right on the cutting board.
Exactly. Because everything is localized on one piece of silicon, they achieve memory bandwidth speeds of 21 petabytes per second.
Which is, what, a 7,000 times advantage over an Nvidia H100?
Yep. The internal routing fabric is roughly 3,715 times faster than Nvidia's external NVLink. They effectively eradicated the memory wall.
And we see it in the benchmarks. The WSE3 can achieve end-to-end token generation speeds up to 21 times faster than NVIDIA's Blackwell B200 at a batch size of 1.
They clocked the Llama 4 Maverick model at 2,500 tokens per second per user. It's blisteringly fast.
But this brings us to the physics trap. You cannot cheat thermodynamics, and you cannot cheat manufacturing defect rates.
No, you can't. Let's start with the yield problem. Standard manufacturing is never perfect. There's always a speck of dust or a chemical variance that creates a dead spot.
If NVIDIA finds a dead spot, they toss that one little die. But if your entire product is the whole wafer, a single microscopic flaw theoretically ruins a $2 million piece of silicon.
How do they solve it? Extreme architectural redundancy. The 900,000 cores are tiny, about 0.05 square millimeters each. Cerebras deliberately manufactures extra redundant cores across the wafer.
And then they use a proprietary routing fabric to map it. When they find a defect, they just logically route around it.
Exactly. They isolate the dead zone and seamlessly bridge to a backup core, effectively achieving a 100% functional yield. It's brilliant.
It is brilliant logic routing, but you can route around a dead transistor. You cannot route around heat and electricity.
Oh, the power dynamics are terrifying.
Let's talk about power, because the Cerebras CS3 system draws 23 kilowatts of peak power.
Think about that. A typical household uses maybe 1 or 2 kilowatts at any given moment. Cerebras is pulling the load of an entire suburban street into a piece of silicon the size of a pizza.
And you can't deliver that power using standard lateral wiring. If you try to push 23 kilowatts from the edge of the wafer into the center through copper traces, the resistance would be catastrophic.
The copper would act like a toaster filament. The wafer would literally melt into slag.
So Cerebras invented a Z-axis vertical power delivery system. Instead of bringing power from the sides, they mount thousands of voltage regulator modules, or VRMs, directly behind the circuit board,
delivering current straight down into the face of the silicon, evenly distributing the 23 kilowatts across the whole surface.
Which solves the voltage drop but creates the thermal sandwich vulnerability. 23 kilowatts of power means 23 kilowatts of heat that must be extracted instantly.
So they use a massive custom copper cold plate with microscopic internal fins, pumping heavy-duty liquid cooling fluids through it.
Now you have a massive PCB, a 300 millimeter silicon wafer, and a heavy copper heat exchanger all clamped together in a hermetically sealed block.
And here's the fatal mechanical flaw. Silicon, copper, and fiberglass have different coefficients of thermal expansion. When you blast them with 23 kilowatts of heat, they all expand. When they cool, they contract.
But at completely different rates. It's like gluing a sheet of glass to a sheet of metal and tossing it in an oven. The friction creates immense shearing force.
To prevent the chip from tearing itself apart, Cerebras uses thousands of custom elastomeric connectors, microscopic, flexible, conductive shock absorbers.
But think about the real-world reality of that. You're subjecting these microscopic shock absorbers to years of continuous thermal cycling.
Expanding, contracting, shearing day after day. It introduces massive material fatigue that an Nvidia GPU just does not have. Over time, microscopic failures could severely degrade the wafer.
And that operational fragility leads right into their business strategy pivot. 30% of their revenue now comes from inference as a service.
Because they practically can't sell these massive hardware chassis directly to enterprise data centers.
Right. Standard corporate server rooms cannot handle a 15U 23 kilowatt liquid-cooled monolith. Standard racks are built for maybe 15 to 40 kilowatts for the entire rack.
This vulnerability is underscored by their new partnership with Amazon Web Services. AWS and Cerebras signed a term sheet to deploy inference disaggregation within Amazon Bedrock.
Let's break down inference disaggregation. AI inference has two stages. The prefill stage is when the model reads your prompt, requiring massive parallel computing, but not heavily bottlenecked by memory bandwidth.
And the decode stage is generating the output token by token, which is severely bottlenecked by memory.
Under this AWS partnership, AWS is using their own custom silicon Trainium 3 for the parallel prefill stage.
And then handing off the process over the network to the Cerebras CS3 solely for the decode stage.
This proves unequivocally that the WSE3 is not a generalized GPU replacement. It's a highly specific, narrow accelerator optimal almost exclusively for decoding tokens at low batch sizes.
Exactly. AWS won't even use the Cerebras chip for prefill because standard distributed silicon does it better and cheaper.
And looking at the total cost of ownership, or TCO, the vulnerability gets starker. 44 gigabytes of on-chips RAM is incredibly fast, but it's a hard fit-to-pull limit.
An Nvidia B200 node has 1.4 terabytes of distributed memory. If you want to run Meta's Llama 3 405B, you blow past Cerebras' 44 gig limit instantly.
So what happens? You have to cluster, you have to chain multiple CS3 nodes together, or use external memory cabinets.
But the absolute second you push data off the wafer down a cable, you reintroduce the exact off-chip interconnect latency the wafer was designed to eliminate.
You defeat the architectural purpose at scale, and clustering is wildly expensive. A 20-node CS3 cluster costs upwards of $40 million for just 880 gigabytes of memory.
Meanwhile, a 32-node Nvidia B200 deployment costs around $16 million for vastly more memory.
Plus, if one Nvidia unit fails, a tech hot swaps it in 10 minutes. If an elastomeric connector fails inside a Cerebras node.
You're calling a forklift. You have to shut down the node, drain the liquid cooling, pull the massive 15U chassis out, and replace the whole hermetically sealed monolith. It's an absolute nightmare for daily enterprise use.
So the hardware is physically brilliant but operationally fragile, which means it's time for a short break. When we return, we'll ask, how on earth are they building this thing? Back. Now that we understand the extreme hardware, we have to look at how it's built. Session 3. Is the Cerebras ecosystem a revolutionary moat or a proprietary trap?
The supply chain fragility is arguably the most under-discussed risk in this entire filing. It all anchors to one non-diversifiable single point of failure: TSMC.
Taiwan's semiconductor manufacturing company. Now, everyone relies on TSMC. The WSE3 uses their 5-nanometer node, but 5-nanometer access isn't the real vulnerability.
No, the actual bottleneck is the packaging. Cerebras requires TSMC's highly bespoke, extremely low-volume, system-on-wafer, or SOW packaging.
Explain how that contrasts with standard AI chips.
Nvidia and AMD use high-volume, standardized CoWoS packaging chip-on-wafer-on-substrate. Those lines are highly automated and run 204/7.
But Cerebras is asking TSMC to maintain the structural integrity of an uncut 300mm wafer throughout the entire packaging process.
Right. It requires unique physical handling robots, unique optical tools, completely distinct chemical processes. It is a niche assembly line tucked away in a TSMC facility.
Which means Cerebras is existentially vulnerable to TSMC reallocating floor space. If TSMC decides they can make higher margins dedicating that space to Apple or Nvidia CoWoS, they can deprioritize Cerebras instantly.
And if a geopolitical shock hits Taiwan, Cerebras production drops to absolute zero.
And there is no plan B. You can't dual source a 46,000 square millimeter wafer to Samsung or Intel. They don't have the SAO-W tooling.
Exactly. But the fragility doesn't stop at the silicon. Building a 23 kilowatt liquid-cooled machine requires heavy industry parts.
Let's walk through these secondary supply chain winners, the pick and shovel plays. We talked about Z-axis power delivery. You need high amperage VRMs capable of stepping down 23 kilowatts.
A company called Vickers Corporation is a critical supplier here. If Vickers suffers a supply disruption, Cerebras literally cannot deliver power to the wafer.
Then there's the physical data center real estate. Standard racks cool 15 to 40 kilowatts total. A single Cerebras cluster draws extreme power in a tiny footprint.
So you need specialized Tier 3 data centers, like Colivor in Silicon Valley, who have specialized 40 to 250 kilowatt liquid-cooled environments.
And the custom ultra-thick PCBs designed for vertical routing. Very few manufacturers possess the lamination presses to build boards of this scale. The entire supply chain is single source.
Which brings us to the human element. This non-standard, highly proprietary ecosystem is not an accident. We need to look at the C-Micro lineage.
Oh, this is fascinating. CEO Andrew Feldman and CTO Sean Lai. Before Cerebras, they ran C-Micro, which pioneered dense microserver architectures.
They took hundreds of low-power processors and built custom fabrics to tie them together. They sold it to AMD for $334 million in 2012.
Feldman and Lai have a well-documented history of executing highly aggressive, high-risk, fabric-first architectures. They reject modular conventions.
At C-Micro, they ignored standard server rules and built ultra-dense clusters reliant on custom networking fabrics. They are applying that exact same philosophy to Cerebras.
Right. They ignore standard PCIe form factors, air cooling, high bandwidth memory. It's the C-Micro playbook on steroids.
And while their engineering pedigree is incredible, this playbook results in severe vendor lock-in. You end up with a closed ecosystem requiring a bespoke software stack.
Which requires massive capital to compete with open source frameworks like PyTorch and Nvidia's CUDA. By the way, AMD ended up writing down the C-Micro acquisition to basically zero because the enterprise market rejected the proprietary approach.
So Cerebras is fighting a multi-front war. They're fighting Nvidia, who has ubiquitous support, and the CUDA Moat. They are fighting hyperscalers like AWS and Google, who build their own silicon with zero margin pressure.
And alternative disruptors like Grok, who optimize for raw speed, but with much lower system costs and standard rack form factors.
But Mira, let me play devil's advocate here. Does it really matter if it's a proprietary trap?
Sure, hit me.
If they've solved the memory wall and generate tokens 21 times faster than Blackwell, won't developers just adapt their code to Cerebras' compiler regardless of lock-in?
In an academic vacuum, maybe? But we live in a world of rigid CapEx budgets. The initial capital cost for a Cerebras node is $2 to $3 million.
Right, that's a lot of friction.
You're asking a CTO to drop $3 million on a proprietary liquid-cooled block, retrofit their data center for 23 kilowatts, and force their engineers to abandon COGA. The enterprise friction is immense.
Which is exactly why they pivoted to inference as a service.
Yeah.
They are trying to rent the compute through the cloud to bypass the CTO's hardware budget entirely.
Exactly. So we have supply chain fragility and a brutal competitive landscape. Let's take our final short break. Up next, the wildest part of the filing, the massive mega deals holding the cap table together. Welcome to the final segment, Session 4. Actually wins in the circular economics of this IPO.
Before we talk about the money flowing in, we have to talk about corporate governance. The stock structure tells you exactly what insiders think of the public market.
Right. They operate a multi-class stock structure. Class A, Class B, and Class N break down the voting power.
Class A common stock, what the public buys, gets 1 vote per share. Class B, held by founders and early VCs like Benchmark, gets 20 votes per share, and Class N is completely non-voting.
So when the bell rings, who actually controls the company?
Immediately following the offering, Class B shares will represent an overwhelming 99.2% of the total voting power.
99.2%. Public investors inject $3.5 billion in fresh capital, but possess functionally zero influence over governance. You cannot elect a board member, you cannot vote on M&A. You're funding the ship, but you're not allowed on the bridge.
And the liquidity overhang makes it worse. There's a standard 180-day lockup, but the S1 notes massive early release provisions. Approximately 171.1 million shares will be released early.
And highlight the Directed Share Program, the DSP. The underwriters reserved 5% of Class A stock for management designees, friends, and family.
Crucially, shares purchased through this DSP are explicitly exempt from lockup restrictions. Insiders are securing an exit into the retail-driven hype immediately, long before commercial viability is proven.
But the crown jewel of this IPO narrative, the metric selling this $26.6 billion valuation, is the OpenAI mega deal.
This is where the accounting gets so circular it makes your head spin. In December 2025, Cerebras signed a $20 billion master relationship agreement with OpenAI.
OpenAI committed to purchasing 750 megawatts of inference capacity by 2028. It sounds like the greatest compute contract of the decade.
It does, until you read the footnotes. OpenAI didn't just sign a purchase order. Concurrently, OpenAI provided Cerebras with a $1.0 billion working capital loan.
A $1 billion loan to fund the massive infrastructure required to serve OpenAI. And it gets better. Cerebras turned around and issued OpenAI massive tranches of stock warrants.
They gave OpenAI 12.69 million shares of Class N common stock at an exercise price of a fraction of a penny. $0.00001, plus more shares authorized post-2025.
Let's map out this compute for equity round-trip mechanism. OpenAI acts simultaneously as the primary customer, the senior secured lender, and a major equity shareholder.
Let's trace the dollar. OpenAI loans Cerebras $1 billion. Cerebras uses it to build custom data centers. OpenAI uses those servers to run AI, paying Cerebras for the compute.
Cerebras recognizes those payments as top-line revenue, showing massive growth to Wall Street. And OpenAI gets deeply discounted equity upside to dump on the public market.
It's a perfectly closed-loop ecosystem. Cerebras trades dilutive equity to artificially engineer a massive revenue backlog, which justifies a $26.6 billion valuation.
Is this organic enterprise revenue or a subsidized vendor finance dilution? It's the definition of circular economics.
It looks exactly like the late 1990s telecom equipment bubble, where Lucent and Nortel loaned customers money to buy their own routers just to engineer revenue growth. When the bubble popped, the vendors collapsed.
We're seeing round-tripping allegations globally in AI today, like with SenseTime in China. It's the game of emperors, massive compute build-outs funded by subsidies, and highly levered cross-investments.
If generative AI monetization flattens, the circular flow breaks. OpenAI could delay utilization, leaving Cerebras holding billions in stranded, customized 23-kilowatt liquid-cooled assets.
Buying into this valuation is a high beta bet that these sovereign-backed circular mega deals will never be interrupted by macroeconomic gravity. So to contextualize everything we've just discussed, we have to look at the violent whiplash of the current equity markets.
None of this is happening in a vacuum.
Right. Just a few months ago, in March 2026, the Nasdaq dropped to 21,590. But over April and early May, the market went on an historic tear. The Nasdaq rocketed over 20% to hit 26,247, and the S&P 500 surged near 7,400.
There is a profound cognitive dissonance in reading this highly fragile, circular S1 right in the middle of a momentum-driven tech wave, where investors are buying anything with AI on it.
Well, that's all for today's deep dive. If you're still listening, congratulations. Your attention span just outlasted Cerebras' organic free cash flow.
Exactly.
Remember, in this market, the Nasdaq is up nearly 5,000 points since March, which means fundamentals are apparently optional and reality is just an accounting artifact. Keep buying the momentum. Try not to think about the 23 kilowatts of heat currently melting through a $2 million sheet of silicon. And remember, if your business model ever fails, just ask your biggest customer for a $1 billion loan so they can buy your own products.
Yep.
But I want to leave you with one final thought to mull over. What if the future of artificial intelligence isn't based on silicon at all? If optical computing using photons instead of electrons reaches commercial viability in the next decade, it won't just bypass the memory wall, it will render it obsolete. If light-based compute scales, this $30 billion wafer-scale masterpiece might just become the most highly engineered, expensive museum exhibit in technological history. I'm your host, signing off. May your portfolio be as artificially inflated as a hardware vendor's top-line revenue.
Let us know what you think of these circular economics down in the comments.